9 windows. All green. I thought I understood my own strategy. Then window 10 said no. And the number that broke it wasn't the win rate. Walk forward means every single trade was validated on data the model had never seen. 11 sequential windows. Not back-tested, forecasted forward. 10 out of 11 worked. 1 didn't. That one is worth understanding. Win rate 54%, and still losing money. That should not be possible. It is. When your losses are bigger than your wins, win rate stops mattering. That's loss asymmetry. It doesn't matter if you win more often if each loss takes back more than each win gave you. That's not a win rate problem. That's a structural problem. First guess. Bull market. Skip the shorts. Sounds logical. It was wrong. The short side Sharpe was nearly 0. The long side Sharpe was negative 0.8. The long side broke. Not the short. Every instinct pointed the wrong direction. Sometimes the obvious answer is just obvious, and wrong. Mean reversion needs a trend that breathes. Not a trend that sprints. A drifting trend has temporarily paused its momentum. That pause is where the edge lies. Price touches the band, trend resumes, you're already out. When the trend starts accelerating instead, you're not fading a spike. You're standing in front of something moving fast. The difference is 10 bars of ADX slope. 2 years. Same symptom. Different disease. Both losing money with a positive win rate. In 2015, both longs and shorts broke equally. In 2024, only longs. The same broken metric, profit factor below 1, was hiding 2 completely different structural failures. Patching one would not have fixed the other. Not just when the trend accelerates, but which direction you're trading. Long entries in an accelerating trend. That was the specific combination that failed. When ADX accelerates, you're entering long into strengthening momentum, the opposite of what mean reversion needs. The short side didn't care, because accelerating trends help shorts. Remove the one combination. Everything else stays. This is the test I was most afraid of. 28 combinations of window length and threshold. If only one works, it's lucky. A curve fit has exactly one sweet spot. A mechanism has a ridge, an entire row where every combination holds up. The S10 row was that ridge. All 7 thresholds. All positive Sharpe. All windows in the green. The S20 row was the opposite. Catastrophic across the board. That contrast is the mechanism revealing. The slower version, 20 bars, broke everything. S20 saw the same final ADX value as S10. But it couldn't see that the value was accelerating. By the time it fired the filter, the move had already started. It kept exactly the wrong trades, the ones entering into acceleration. S10 removed them. Timing matters more than the idea. Fresh data. Data I hadn't touched during the entire investigation. The filter held up. Window 10, fixed. Not by patching it. By understanding why it broke. IS over OS efficiency above 1. That means out-of-sample results were better than in-sample. That's not normal. That's what a real mechanism looks like when it transfers to unseen data. Someone will ask, Nasdaq and US 500 move together anyway. Price correlation is 0.95. So the filter just fires on both at the same time, calling that confirmation is circular reasoning. Price correlation and signal correlation are not the same thing. The question is not whether prices move together. The question is whether the filter fires independently. ADX slope correlation, 0.75. That means on roughly 1 in 4 bars, one asset gets filtered and the other doesn't. Look at 2024, rolling correlation dropped below 0.65. The markets partially decoupled. The filter still worked on both independently. Not the same signal. Not circular. Structural. 7 ideas. 1 mechanism. Mean reversion works when the trend rests. When the trend starts running, you're not fading in overextension. You're just early, in the wrong direction. The market doesn't care whether you're long or short. It doesn't care whether it's US 500 or Nasdaq. When it accelerates, the edge disappears. When it rests, it comes back. Transaction costs not modeled. Not trade ready. Stage 2, measure first. Trade later. Code on GitHub. Not financial advice. Just process.